Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Listen, if this is your first time listening to the show, be sure to hit the subscribe button so you don't miss an episode. And if you haven't done so already, leave us a rating and review. I want to hear what you love about the show or what you like about it. You don't have to love it, but I love it. But hey, tell us what you think about the show and what can make it work a little bit harder for you and your investing goals. We know times are changing and everyone's trying to sharpen their pencil. So now's a great time to get some feedback so we can bring on the kind of guests who can help you succeed with your real estate portfolio. With that in mind, we got a great show today. We're going to be talking to NJREN Fragnito. NJREN Fragnito is a senior managing member and co-founder of People's Capital Group. Now, NJREN is also the host of the New Jersey Real Estate Network, the Cash Flow Podcast. Now, he's an adjunct professor at Rowan University, all while being a full-time real estate investor. Now, he has built an 8-figure real estate portfolio and is well-known name in the real estate investment market all throughout New Jersey. Let's welcome to the show, NJREN Fragnito.
Thank you, John. Glad to be here. I feel like we need a background applause going on. You know, that would be a nice touch to have. Absolutely.
I love it, man. I love it. Well, listen, NJREN, I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Sure. So I own and operate a company called People's Capital Group, and we primarily buy apartment buildings in New Jersey. We're a vertically integrated real estate investment firm, which means we have an in-house property management company to help manage these properties that we often buy as mismanaged assets and improve them and renovate them with our contractor teams. And then we lease them up for top dollar. We reposition apartment buildings and we harvest that equity growth for our investor group so they can get the benefits of owning real estate like cash flow and tax depreciation and large lump sums upon the cash out refinances that are tax-free, but not have to deal with all the shenanigans of being a landlord and the headaches behind the scenes to renovate these buildings and take a mismanaged asset and turn it into a performing building where people want to live and move in and raise their family, and they're willing to pay a little bit more rent to do that. So that's our goal here at People's Capital Group, and we've been doing this about 10 years, strictly in New Jersey.
I love it, man. And listen, for anyone who's listening to this show for a little bit of time now, that strategy is one we talk about frequently, right? Because you're able to go out there, find a property where you can add value, right? Through operations, improving the property management, making some renovations, and then ultimately by increasing the NOI, the net operating income, that property is worth more in value. Now you can return some of that capital, you can do a refinance, you can sell the asset, and it allows you to get all the benefits of owning real estate, but you can do it passively. So you don't have to be the person when you've got someone like NJREN and his team that is willing to take on a lot of that work. You mentioned that this is all done in New Jersey, right? I'm really interested in learning a little bit more about kind of the size of the deals you're doing. And then New Jersey, isn't known for being a landlord-friendly market. So talk to me a little bit about how you navigate the local market and some of the ordinances and whatnot there.
Oh, yeah. That's one of the more challenging things I'd say about what we do, navigating the red tape of investing in a blue state, which I always thought was a great title for a book. So I'm going to work on that one.
Say it again. You said navigating
red tape in a blue state.
Red tape in a blue state. Man, that is good. I like that. You better write that book before I do.
I know, right? I better copyright that. Absolutely. And, but that's it. That is it. We have been investing here for years and we've developed a really good infrastructure, a good group of contractors and property manager and just all the service providers you need to invest. And then as well as our investor pool are primarily New York, New Jersey individuals that know these cities we're investing in, Newark, New Jersey, Paterson, New Jersey, Jersey City, Bayonne, Rahway, areas that allow you to commute into Manhattan in generally an hour or less. Which, with the pandemic became a little bit less important, but is still very, very important to be able to commute into Manhattan ideally, and still a huge demand for that. And we saw a lot of people actually move out into Jersey through the pandemic. But we focus on this north central Jersey pocket here. A couple of things. We've built a great infrastructure to manage the assets well. We have a good team to find good deals. We work with a lot of realtors and wholesalers and landlords. And we have good relationships that allow us to source or discount apartment buildings for sale in this market that is extremely high demand. So you definitely need to know how to navigate the red tape in a blue state. You need to know the difference in rent control laws from city to city. And I own properties in Paterson, New Jersey, and right across the river is Passaic, New Jersey. The neighboring cities, completely different rent control laws, right? Same with Rahway to Elizabeth, neighboring cities, completely different rent control laws. So rent control is actually very local, and it's really just city by city. But what happens is rent control is enforced in a city because, quite frankly, rent's growing too aggressively. And, the tenants complain to the politicians, and the politicians want to remain in power. So they say, well, to remain in power here, to keep my votes, I'm going to enforce rent control because there's more people that rent who vote for me than there are people that own the apartment buildings, right? And that's just statistics speaking. So it makes more sense for the politicians to enforce rent control. What happens then is those markets tend to get capped, but they still continue to grow in value, just huge, very high demand markets that continue to grow in value. And in markets around them tend to also continue to grow in value as well. But often markets around those high red tape markets with high level rent control and very complicated rent control, the markets around them have less complicated rent control or less restrictive rent control. For example, I'm buying in Bayonne, New Jersey right now, a 21 unit property. And I'm not buying a 21 unit in Jersey City, New Jersey, which is right next to it. And the reason for that is because you're paying more money to buy real estate in Jersey City, first of all. And secondly, the rents on the property I'm buying are 35% below market value. 75% of the building is free market, meaning when a tenant moves out, I can increase the rent to whatever the market is bearing. I don't need to go in front of the rent control board. I don't need to show them I've done these renovations, and then they allow for a fractional increase based on the renovation cost, which is, if I had a building in Jersey City, a stone's throw away, I'd be having to go to the rent control board, show them all the renovations I made to each unit as a tenant moves out, and they would then decide a fractional amount of rental increase I could do based on that investment. Now, with rents 35% below market value, say I wanted to raise the rent 35% on a unit when a tenant moves out, I renovate the unit. A lot of times the cost to do that would be like $60,000 or $70,000 of investment into that one unit just to get the rent up 35% or 45%. Wow. Yeah, because the city only allows you to increase it a fraction of the amount of money you're investing into that specific unit, right? But part of the magic of repositioning apartment buildings is keeping your costs low, as well as making sure you have a nice quality unit that has the finishings and the whistles and the bells, the amenities that tenants are demanding in that demographic. So you attract the right tenant, you treat them the right way. But as business owners, we want to keep our costs low and do it at the most efficient cost. So in Jersey City, you need to break the bank just for the city to allow you to increase the rent, for that. So it's a really restrictive rent control policy, and that's one city away. But that high demand city, if you buy around that area in cities like, for example, Bayonne, where they're building a ferry to get into Manhattan in 20 minutes, where a 10-minute walk to a light rail station, you could be in Manhattan in 30 minutes. So the commuting situation is very similar to Jersey City, practically the same. But we have much less restrictive rent control in that city, and that allows us to flourish more as landlords and be able to reposition these buildings faster and not be so restricted by the red tape.
Yeah, Aaron, I think you just gave a lot of information. We got to take a little time to unpack this a little bit. But first of all, my big thing here is that, there's obviously red tape when you're talking about some of these blue markets, and when you're talking about New York and New Jersey and some of these markets, especially the ones that have rent control in place, there's going to be a lot of challenges. Now, a lot of our listeners, we know that, hey, you want to invest in areas where it's easy to do business. So maybe that scratches Jersey off the list for you. If that's the case, completely fine. With that said, I do think it's important to at least understand how you can find and create opportunities given this market. And because there is rent control, we know that there are going to be a lot of investors who turn the other way and say, you know what, I want no parts of this. I'm going to invest in a different market. But for someone like yourself who understands those laws, who understands how to navigate that, you can find opportunities, and maybe that competition isn't as stiff because you do have a lot of people who are not looking to partake in rent control. The thing that jumped out to me is that it sounds like many people maybe think of rent control as kind of a unilateral set of laws, but it really is local, and every city has different rules. You mentioned one city, allows you to keep 75% at market rate, and then they only have maybe restrictions on 25% of the units. Whereas in Jersey City, the rent increase has to be tied to the amount of money you put in for your renovation. So it's going to vary a little bit, and that's going to give you the ability to understand where you want to invest versus where you don't. And no matter if you're in Jersey City or a different market, it really comes down to your local municipality. You have to understand how those rules are made, what the restrictions may be, and how to navigate that accordingly. Let's talk a little bit more about this before we move off of rent control, right? Because, we're looking at, rents shooting up right there with inflation, right? So we're seeing all these numbers shooting up. And in many cases, as real estate owners, as landlords, property owners, that's a good thing. But there are some drawbacks and concerns. And one of the big concerns is that, you will have more politicians who look at this because you're going to get more complaints from residents and they will feel the need to step in and do something. Do you see rent control kind of expanding and growing, getting more steam? Or do you think that, hey, this is something that people believe in, but in theory, maybe it isn't as effective as some politicians would have you believe?
It's hard to say what the future holds with politics, right? I mean, if anyone tells you they know what politicians are going to do, next year, they're lying. It's hard to say. It's interesting because Bayonne actually has a little bit more of Republican basis than some other cities around it. So we do see that, but there's also been areas where, like Union City, for example, the rent control is too strict, and it's just really devastated the rental market in a lot of ways and the resale market there. So it actually gets to a point where I think it gets too restrictive. And then a lot of people are like, hey, but I own a duplex. I live in one of the units and rent out the other, but now I have to charge them, $1,000 a month for a $3,000 unit. This is crazy. Why would I be forced to do that? And so it's just a really, what happens is if it gets too restrictive, people actually do start to vote the other way. But it's tough to say, right? People move in, people move out of the city, so cities go different ways over time. What I've found is that, by the way, that the building we're buying, the reason 25% of it is rent controlled is because when those tenants, if those tenants move out, those units automatically go to free market now. So that's another benefit of a
so those restrictions are lifted then. They're just right now 75 sold. So that sounds like basically a deal where maybe it was under some LIHTC restrictions or something like that, and now it's come back and it can go to open market when those units become available.
Yeah, it's not even like LIHTC restrictions. It's really just at the end of the day, that's the rental structure, the ordinance in that city is that when a tenant moves out of a rent controlled unit, if and when that unit becomes fair market. And of course, we would renovate the unit and then lease it up for whatever the market's bearing. But say in Jersey City, for example, if a tenant moves out, you're not allowed to increase that to fair market. You have to renovate it and show what you've done to the board before getting it. So, but the bottom line is when we're buying in these high demand markets with rent control in place, we're recognizing it's just a cost, right? It's part of the business. It's like a renovation cost, right? Or a whatever it is, when you're buying real estate, you have service providers, you have million costs, right? So it's simply another cost we've recognized, cash for keys to encourage tenants to move out of rent controlled units where you work out a payment amount. That's one way to work with rent controlled units. And there's others as well, but it comes down to amount of risk, and risk is just a number. And, as you do with any type of building, anywhere you're buying, you're calculating your risk, and there's pros and cons. Maybe investing in maybe a less desirable market with no rent control. Yes, that can have its benefits, but then again, you have to watch out, in high demand, in recession, you're going to be struggling more than high demand markets where we try to really focus on these high demand markets in North Jersey, where there's so many people living here. There's so many jobs. There's so many high incomes around. There's so many people looking to rent and buy homes that it continues the demand in the market, so much so that they have to tamper down the growth of rent by doing rent control measures in some cities. So that's our main focus, is buying in these high demand pockets of North Jersey. And then, you look at the rent control and you just say, okay, is that something I can work through? In some cities like Bayonne, it is worth it. It makes sense. We can navigate it wisely. In other cities like Hoboken or Jersey City, we don't really like the structure there. So would I never buy there? No, I would always look at opportunities that might make sense in one way or another. But for the most part, we have to recognize that that challenge coming in, and that tends to not make deals work on paper. And that's if it doesn't work on paper, it doesn't work in real life.
Yeah, I think it's a great insight there, right? First and foremost, and this is true no matter what kind of deals you're looking at, but you have to understand the demographics and the demographic trends. And what you're talking about is you like looking at areas of Jersey and North Jersey in particular, where that growth is there, right? You're still seeing people who want to live there. Demand's going up, rents are going up. There's strong demand. And then you're trying to understand what the political landscape is in order for you to navigate the deal, right? So the fundamental elements are there. Now we've got a little bit of red tape we've got to manage through. Some of those cities, you're not willing to deal with it. Some you are. And no matter if you're dealing with rent control or not, I think the process is the same. You want to take a look and say, hey, what's driving this market? Is this a desirable location? If so, okay, great. Now that I've decided this is desirable, what do I need to know about this area and investing in this area and managing and owning in this area in order for me to navigate this and make sure we have a good deal? So really good insight, whether it's rent control or not rent control, there's always going to be something that you're going to have to navigate. It's funny because I'm from Cleveland Heights. And in Cleveland Heights, Ohio, I didn't know this because I didn't really invest in Cleveland Heights. But as I got to know other people who did, there's an ordinance that basically when you buy a house, you have to have a certain level, like a certain inspection or something like that done. And you have to pay for it yourself. And people, if you go on like Bigger Pockets, people complain about it all the time. I had no idea. And it seems weird and odd to me, but they want to make sure basically that they're protected and you're buying this house and you understand what you're going to do to this house. So there's always little things like that you may not know about. And obviously rent control is different, but you have to understand what that local municipality's laws and ordinances are so that you can navigate the situation accordingly. Now, with you syndicate, you raise money just like we do. I think the thing that's different, and one thing that's interesting to me, is you do have these outlying restrictions, right, from the government. And I'm curious how you structure your deals or how you mitigate the risk that come from having rent control and rent restrictions in place when you are working with other LP investors. Can you talk about that?
Sure. So, at the end of the day, we're structuring deals probably very similar. We have a preferred rate of return that is a higher rate if you invest more money. So that's pretty straightforward. That allows our investors to get paid first on the net proceeds of the transaction, and such as net cash flow and cash out refinances as well. We do an equity split, generally the investors owning the lion's share of the equity, around 70% or so. One thing that set us out in the past is we actually don't charge an AUM, an assets under management fee, which we're actually probably going to start changing going forward. But for our current fundraise, we don't charge it. We try to kind of keep our fees very low, no disposition fee or anything like that. So, mainly equity play on our end. We try to make most of our proceeds on the equity side of the business, so that we need to perform to put food on our own plate. But the way our fund is structured, I would say, is pretty industry standard for the most part. There's rules and regulations within what we need to do to make sure the building and the project is moving according to plan. And but for the most part, we have our LPs, our non-voting members, that are bringing the capital to the table. They enjoy monthly updates, quarterly financials, quarterly cash flow checks. But the main difference probably between what we're investing in and what maybe people that are investing in Southeast or Southwest or areas that you're going to get a little more real estate for your dollar, those areas tend to produce more cash flow, where we tend to pay our investors more so on the equity gains of the real estate. Okay. So our cash flow is around 2 to 3% a year cash on cash return. Okay, so $100,000 investment, you'd expect maybe $2,000 to $3,000 a year in cash flow on our buildings. Now, that may not sound like a lot, but then of course, the cash out refinance, we aim to get about $50,000 back, or half of your investment. And the whole goal there is that's a non-taxable liquidity event. And you've probably gone over this in your podcast before, but I'll reiterate. The reason it's a non-taxable liquidity event, which means you essentially get a large cash payout without having to pay taxes on it. That's a more layman's term there. The reason it is that is because it is debt. Now, it's debt that ideally is a low interest rate that the building can handle, that the tenants are going to pay down for years to come. It's debt that does not have to be personally guaranteed by the investors. Sometimes Seth and I do, but for the most part, we never have our investors personally guaranteed debt. But it's debt that the asset's going to pay down for years to come, and that debt is not able to be taxed by the IRS, because the IRS doesn't tax debt. But you pay off the old mortgage, pay off any other debts, you have cash left over in between, and that cash is distributed to the investors. It's a way to harvest our equity growth without selling the building, right? It's not cash flow. You're not selling the building. You're not losing your cash flow machine. You're not losing your tax write-off machine. You're still able to collect that quarterly cash flow write it off with tax depreciation, so the cash flow creates no additional tax burden, and then continue to get a large lump sum upon the refinance. The best part is it doesn't dilute your ownership when we do the refinance. Okay, so if you invest $100,000, say, you expect $50,000 back in the refinance, you still have your initial $100,000 invested in the opportunity. You still have your full $100,000 worth of units owned in the LLC. And now you have the option to exit the LLC, get back your initial $100,000, walk away in that case with about $150,000, right? The $100,000 principal, $50,000 for refinance, and let's say another $5,000 or $10,000 in cash flow. But you'd have to pay capital gains tax on that $55,000 to $60,000 in earnings if you exit the LLC. So we have that flexibility in there for our investors, but 90% of them choose to stay invested long-term, continue keeping that principal working, continue to earn quarterly cash flow and big lump sums upon the refinance every 3 to 5 years. And that's our main goal with buying in high demand markets, continue to reposition the property. And eventually down the road, maybe 15 years or so, we'll do a 1031 tax deference, trade up to a bigger building, defer all taxes, and build our investors legacy wealth indefinitely. So that's another thing that sets us apart. We have the in-house management company, but we also never insist we buy our investors out. We never kick you out, where a lot of funds tend to have a 3 to 7 year window, and you exit the investment, pay taxes, and move on to another investment they have. It's no wrong or right structure. We just have a different structure for our business, and our investors are allowed to stay in indefinitely, which most of them opt to do for tax reasons and because it makes sense once the building's humming on all cylinders to stay invested long term.
Yeah, Aaron, there's a lot of unique elements to the way you're doing your deal. So I want to recap this a little bit. So one, your overall deal structure, you focus a little bit more on the long-term play than kind of the short, capital infusion that many investors do. What I mean by that is, you are looking at more of a 15-year hold potentially, so a longer hold period, not necessarily always 15 years, I'm sure, but more of a longer horizon on the hold period. You're looking at a 2 to 3% annualized cash flow, so it's less than maybe the 6 to 8% that some operators are looking for, and you're looking at doing a refinance to return about 50% of the equity. One, when you're doing that refinance, around what time are you looking to do that? Is that year like 3, or when exactly are you looking to do that typically?
Yeah, on our pro forma, we give ourselves a 5-year window to get there, but we have accomplished it in 2 years, getting a 24% annualized return to our investors. We've accomplished it in 3 years, and on some projects, with different headwinds, it can take up to 5 years. Yeah,
makes sense. So then, from there, you give the option to investors, and if I'm understanding this correctly, you're saying when you refinance, investors can either stay in the deal and keep riding the wave, and their shares are not diluted. So if you invested $100,000 and that got you, 100 shares, you still own your 100 shares. So, when you go and get the profits, when we eventually sell, you get whatever that equity, that slice is. Mm-hmm. But you also give the option to say, hey, if you want to cash out and move on, you can do that. So in that instance, is that option only available during the refinance, or is that open at other time periods throughout the holding period?
Right. The investors only have that exit option at each refinance. Yeah. Mm-hmm.
Okay. Got it. So that makes sense there. So, because I think it's important to understand, these are illiquid assets, right? It's not something you can just decide tomorrow you want to do something else with your money and sell. It just, there's a process to go about that. So I think the longer hold period is one thing that's a little bit different. And then as you talked about, the cash flow and just the cash flow expectations are a little bit different as well. So for that investor who maybe has done, LP deals in Texas or Florida or Georgia or some of these other markets that are those more, 3 to 7 year hold periods, what are some of the concerns or questions that you get for people who maybe have experience investing in these other types of syndications?
Sure. So I have people contact me all the time that are investing in Texas, the Carolinas, Florida. Those are pretty much Tennessee, Alabama, and they're like, okay, I got into a deal. I got out of a deal. I did pretty well on it, but then I had to pay 25% capital gains tax. And I know we spoke 3 years ago, Aaron, about your returns, and you were saying to me, listen, if you take out the tax you're going to end up paying with that structure, you're going to end up exactly where I am with my internal rate of return targets and cash return targets, which, are 10 to 12% annualized cash return. And, 17 to 21% internal rates of return, which are pretty industry standard, pretty aggressive, pretty up there. But I've also seen, there's always a person putting up higher numbers, higher targets, and really a target is just that. It's about worth the weight of the paper it's on. But a target is what you put out there to try to set up your manage your investors' expectations, of course, right? So we have to be careful not to put too high a target and assume, you can't tell the coach every time you go out, you're going to hit a home run. It's just not going to happen. You're going to strike out a few times. You're going to hit some singles and doubles, and the best hitters get on base like a third of the time, and that's what we want to do is manage our investors' expectations, expect inflation to slow down, expect rent to stop growing so quickly, expect recession headwinds, but also just long-term, expect a large amount of lease loss and taxes to go up, insurance to go up. So every dollar I increase rent, I increase my expenses by 50 cents or 40 cents, depending on the market and so on. So managing our investors' expectations and then explaining to them, hey, at the end of the day, if you make $100,000 of profit on this deal and you have to give 25% to the government, or you make $75,000 in profit on this deal, but you get to keep all of it, it's the exact same thing, right? Because at the end of the day, you're just earning more here, but your tax burden is diluting your ownership really down to where it was going to be anyway in a refinance where, the idea is to keep all your money and not give it to the IRS. So we tend to find that a lot of those structures where they're buying, renovating, and selling the building, they get bigger returns up front to their investors, and that's great for everyone, and that's great for the fund because then they recycle that money into another deal, and there's fees to be made on acquisition and sale. But at the end of the day, it's what you keep, right? It's not what you make. So a lot of people do come back to us and say, hey, I invested in other areas. I did well, good operators, good structure, but you were right. I got nailed on taxes. And, maybe I'm a doctor, I'm a lawyer, I earn $250,000 a year, I'm a banker, and I get nailed on taxes already. I'm already giving the government like $75,000 a year in income tax. So it doesn't make me feel really good to give them another 25 grand on top of my real estate earnings. So it's almost like a way, listen, is it the same at the end of the day, whether you make 100 grand and give 25 to the government, or you make 75 grand or keep it? Yeah, it's the same. But in one of those scenarios, you're not giving 25 grand to the government, and in some cases it can be more than that. So it's 6 to 1, half dozen the other. The truth is you probably want to diversify over a number of markets with a number of different operators, and hopefully you're in a position to do that. And I do suggest that to investors all the time on the phone.
Well, and I think too, as we plan for taxes and plan for the upcoming year, these are all the kind of things that you should be thinking about and kind of putting your strategy together in place. And obviously, if you have a tax professional on your team, sit down, consult with them. If you don't have one on your team, get one, right? Figure out how you can save some of this money for your own investing goals. And I know that you have put together a new ebook to talk about investing in real estate for the upcoming year, 2023. Talk to us a little bit about that.
Sure. So it's called Why 2023 is Ripe for Real Estate Investing. And I really think we're at the crossroads right now. I mean, your guess is as good as mine, but it looks like property values are going to start coming down. I haven't really seen that much around here just yet, but I have seen the temper, the excitement and the buyer frenzy slow down on commercial assets here. So I am in one of the higher demand markets, so we might be one of the last to see those prices start to come down. And that's, could be good for my real estate values, but also tough for me as a buyer to get more deals. So I do think, though, in the next 18 months, we're going to see some real series of great buying opportunities. I started investing in real estate in 2010. And the only thing I regret is not buying more real estate from like 2010 to 2015. I didn't have much money and experience. So, there were some challenges there, of course. But, if I knew then what I knew now, right, I would be owning a lot more real estate. So I think we're going to see some of those opportunities, not anywhere like we saw prices in 2010 to 2015, of course, but we are going to see prices get more reasonable for buyers. And you have to look at the good and the bad with everything. Interest rates will be higher, so you want to be creative with how you invest as well. But I think the next 18 months is going to be ripe for investing and snagging some great opportunities, some discounted apartment buildings for sale in high demand markets that 5 or 10 years from now, my investors will say, hey, remember that deal we got during the recession? That was some of the best investments I've ever made. And that tends to be when you get your best deals during a recession, right? When there's blood on the streets, or as Warren Buffett says, and others are, greedy, be scared, and others are scared, be greedy. Well, right now we're about to see a lot of scared investors, and probably rightfully so, with interest rates going up and everything else. So don't go out and just buy anything and everything. But, by knowing the right people to work with, reading books like these, understanding why 2023 might be a great buy opportunity and why you should have your ear to the pavement, find a great deal or find a great company to invest with, and how to do that. That's important to do. So I think you want to be ready for it. We might see some great opportunities. Yeah.
All right. Well, listen, you can check that out on your website. It's peoplescapitalgroup.com. That ebook is available right there. And we are going to move on to a round of insights. Aaron, you ready?
Go ahead. Yeah.
All right. Give me a failure or an apparent failure that sets you up for later success.
So we were really good at flipping small and mid-sized homes. Then we got into flipping high-end homes, and we did not do well on high-end homes. We used a lot of the same contractors from inner city areas and moved them out into the big, expensive suburbs, and it was not a success for us. So I learned that your contractors don't know their limitations. Sometimes you have to know their limitations for them, and to be a good manager, say, no, we're going to keep you on these jobs over here. I also learned that, mid to small level homes are a different beast than the high-end homes. So stick to what you know. That's why we stick to apartment buildings here in New Jersey, Class B and Class C real estate. There's plenty of people that say, come to the Carolinas, come to Florida, or invest in warehouses, or do ground up development, or why do you do this, why do you do that? Because we stick to what we know. We do it very, very well. And in business, I've done this long enough. When you're doing something well and you're beating expectations, stick to it and just improve those systems.
I love it. Give me an app or digital resource you recommend for your business.
I use Appfolio to manage our properties here. It's almost like having another employee in a sense. And then I use Syndication Pro to manage the investment side of the business. And I use Active Campaign on the CRM marketing branding side. So,
give me the book you've recommended or gifted the most in the last year.
So Rich Dad Poor Dad is actually what I assigned to my class at Rowan University. I teach real estate entrepreneurship, which is also a course I wrote. And the first book I assigned in that course is Rich Dad Poor Dad, because that's how I got started investing in real estate. It's an easy read. It's a fun read, and anyone should read it getting started. Or even if you don't like real estate, just read it. It's great for wealth understanding.
Give me a daily habit that helps you stay focused on your goals.
I mean, I don't do it daily, but I should. I'd say exercise. I love exercising, especially if I can get outside and exercise.
Give me your number one insight for multifamily investing.
Use the word no more than yes. It'll make you more money.
All right. I like that. Now, you're out in Jersey. What part of Jersey are you in exactly?
Somerville, New Jersey is where our office is.
Somerville, New Jersey. All right. Give me your favorite place to grab a bite to eat in Somerville or somewhere around Somerville.
I like Mike's Courtside Kitchen. They make a mean buffalo chicken salad for only $12.95, and it's hard to find a good salad these days for less than $13.
I love it. Well, listen, we'll make sure we put that on the list. Aaron, you gave us a lot of great insights. We haven't really had a lot of rent control conversations, so I really appreciate you shedding some light to how it works, how it differs, some of the risk, and then also talking about your deal structure, how you're in it for the long haul with your deals, looking at longer term holds, but giving investors the ability to get some of their money back through refinance, as well as kind of that exit on their capital. So really interesting approach. And I hope that listeners got a lot of value from the information you were able to share today. Again, if they want to learn more about you and check out that ebook on why 2023 is ripe for real estate investing, they can go to your website, peoplescapitalgroup.com, and check it out there. Again, I want to thank you again for coming on the show today, Aaron. We hope you have a great one, and I look forward to staying in touch.
Thank you, John. Good night.